Okay, guys, let's do Daniel Jack. Daniel Jack is a little bit, it is minute. The inventory part of the question. The rest is also really a financial statements question, and it's excellent revision on the work that we've done thus far. Okay, let's assume a VAT rate of 14%. Sherry and Brandy are sisters who run an accounting practice to assist their clients with the financial records and financial statements. On the morning of 3 May 2015, Sherry found the following note beside her bed. Dear Sherry, last night the captain asked me to marry him and I accepted. I am so happy. To celebrate our engagement, Morgan surprised me with tickets to a desolate island for a 2-week holiday. As you read this, I'm really on the plane. As you know, I was busy doing the financial statements of Daniel Jack Manufacturing for the year ended 31 March 2015. Oops, come. Let's just color that in, and I have not been able to finish. They need the statements for the management meeting in 2 weeks' time. There are still adjustments to be made, as well as some corrections of errors. A new junior bookkeeper, Bud, was appointed in March 2015 and was very inexperienced and was unsure how to handle some of the transactions and year-end adjustments. Everything is on the computer and there's a file on my desk explaining what still needs to be done. Your assistance is much appreciated and I will help you with one of your clients when I return. Love, Brandy. As she was busy working on the other client, she asked you to assist with the statements of Daniel Jack Manufacturing. The following was a trial balance that was found on the computer. Daniel Jack, trial balance as at 31 March 2015, so that is thus far. Cash and cash equivalents, debit balance, property, plant and equipment, the carrying amount, raw materials, 31 March 2015, closing balance. Work in process, 31 March 2015, closing balance. Finished goods, however, opening balance. So what does that tell us? They're using the periodic inventory system and they haven't updated their inventory account as yet. Allowance for unrealized profit, 1 April 2014, 9,200 Rand. Also opening balance. So that was applicable. Those two goes hand in hand. The 9,200 is applicable on that finished goods inventory balance of 101,200. VAT control credit balance, capital drawings, mortgage bond, 12% mortgage bond, debtors, allowance for credit losses, creditors, allowance for settlement discount on creditors. Rent income, sales, cost of goods manufactured. Good. Not cost of sales, cost of goods manufactured. Very important. And that would be the amount that's been transferred out of the work in process account to the finished goods account. Interest on the mortgage bond, interest on the 30 days deposit, selling expenses, and admin expenses. The following additional information was found in the file. All transactions relating to VAT should be taken to a VAT control account. Number 2, let's just, before we start going down here, calculate the amount to be shown in the inventory line item as it would appear in the statement of financial position for Daniel Jack Manufacturing as at 31 March 2015. So the A part is the inventory line item as it will appear. The second part is the statement of profit or loss for the year, and the third part is the statement of financial position for the year. So that first part really is going to feature in the last part as well. So let's do the inventory item first before we worry about anything else. 2 is all about mortgage bonds. 3 is about depreciation. 4. Now that is about raw materials, so that's got definitely something to do with inventory. An invoice for raw material amounting to 25,650. Now that was the invoice amount, and an invoice amount always includes VAT, and an invoice amount is always after a trade discount was already been deducted. If I don't want you to assume that the trade discount was deducted, I would have told you the invoice value before any discounts or before the trade discount was being deducted was X. But in this case, if I only talk about an invoice, it means that the trade discount has already been deducted. The materials were delivered at the end of May and were included in the inventory count. Now we can assume that our closing balance, as they give it to us in the trial balance, that raw materials as of 31 March 2015, the 58,400 was the inventory count. So there is nothing wrong with that amount, because this was included in the inventory count. The supplier offered settlement terms of 215 in 45. Daniel Jack always takes advantage of settlement discounts from suppliers. No entry has been made for this invoice. Now, we are not going to fiddle around with the inventory value because we've already said that the inventory value is correct, but we still have to account for the invoice. Now, if we go, it's raw material. Guys, so the raw materials on hand, that amount is correct, but most probably the raw materials issued, that amount is not correct. And raw materials issued is included in this amount of cost of goods manufactured. So what we're going to do in this case is we're going to debit our cost of goods manufactured. With what amount? Now, if we take the 25,650 and we say, well, 25, let's write it here, 25,650 divided by 1.14, if we take out the VAT, gives us 22,500. Now, we know that we're going to make use of the 2% settlement discount. So 2% of 22,500 equals 450 Rand. And we have already seen in our trial balance that we have an allowance for settlement discount on creditors. So we're obviously making use of a settlement allowance account. So that would have gone to the allowance for settlement discount on the creditors. Good. Then the 98%, that equals 22,050. And that would have gone against our cost of goods manufactured. 22,050, we would have debited the allowance account with a 450. We would have debited VAT with a VAT amount, which is basically 22,500 times 14%. And that gives us 3,150. And we would have credited our creditors with a full amount of the invoice, which is 25,650. So let's quickly go back and let's adjust our pre-adjustment trial balance. Cost of goods manufactured, that would have increased with 22,050. Our allowance for settlement discount on creditors, that would have increased with 450. Our VAT control account's got a credit balance, so there will be a debit against that account, so that is going to decrease with the amount of 3,150. Just color it in, 3,150. And then obviously our creditors would have increased with a full amount of 25,650. 25,650. Then we have taken care of that one. But as you can see, there's no impact on our inventory balance because that balance there is the inventory count balance. So we're not going to fiddle around with that one. Okay, 5 is all about rent, 6 is all about debtors, 7 is about, It is the policy of Daniel Jack that goods are transferred to the sales unit inclusive of a consistent manufacturing profit percentage. But I've never worked with a manufacturing profit and no calculation has been made. So that means if we do look at this amount here, that is 1 April, that is 1 April. So we can determine what is the so-called consistent manufacturing percentage. 101,200 includes unrealized profit of 9,200. So what was the actual cost price of those goods at the beginning of the year. 101,200. Let me just see where I've done that. 101,200 less 9,200 equals how much? 92,000 rand. So what is the unrealized profit then? The unrealized profit was the allowance was 9,200. What was the actual cost price of the goods? 92,000. So how much was at the end of the day the profit percentage that we have added to the cost of manufacturing when we transferred the goods to the sales department? 10%. Right. Good. At year-end, inventory count concluded that the total finished goods on hand on 31 March 2015 amounted to 107,800 rand. This amount includes the manufacturing profit. So, what we would like to know is what is going to be the allowance for unrealized profit at the end of the year. So, what's going to be the balance? And that's going to be 107,800 times 10 divided by 110. That gives us a balance of 9,800. That is what we want this allowance account balance to be at the end of the year. So, if that balance at the end of the year must be 9,800, obviously we're going to need to credit this account with 600 rand. Then that balance will become 9,800 rand. There you are. Now we're going to credit this account with 600 rand. What are we going to debit? We are going to debit here. Let's see. Why don't you want to put it there? Let's put it there. Our unrealized profit. Which one? P&L account. With a debit of 600 rand. And at the end of the day, we're going to transfer this and it's going to be set off against our cost of sales. So unrealized profit, debit 600, allowance for unrealized profits is going to be the credit with 600 rand. Good. And then they talk about cash and cash equivalents. So let's quickly finish off our inventory notes. The first, what we're going to calculate, what our inventory is going to look like. Now, raw materials is going to be 58,400 rand. So if we go back here, let me just see, where is my inventory? There it is. Raw materials is going to be the 58,400, which equals the amount that they gave us, 58,400. Work in process is going to be 84,600, which is the amount that they gave us, 84,600. Finished goods, we said finished goods, the balance was 107,800, but that includes the allowance for unrealized profit of 10%. So if we take out the allowance, which is the 107,800 times 10 divided by 110, that is 9,800, and that is what we decided. The allowance accounts balance should be at the end of the year, 9,800. So we're going to subtract it from the closing inventory, which they gave us, the 107,800. That is going to give us net finished goods of 98,000 rand. So if we're going to add all these together, there is no consumable stock in this question. So the total value of inventory, as it will be disclosed on the face of our statement of financial position, would be 241,000. Now, if you've written down your templates already, we can go and insert it on our statement of financial position, inventory, 241,000 rand. Inventory, 241,000 rand. Let me just do this. Great stuff. Good. So we finished off the first part of the question. Calculate the amount to be shown in the inventory line. Good, let's go back and let's do them now one by one. Number 2 here. The mortgage bond for the purchase of land was taken out on 1 April 2010. Long time ago. The loan is repayable over 20 years with payments of 16,615, which includes capital and interest on 30 September and 31 March each year. So there are 2 payments that takes place on a 6-monthly basis, one at the end of September, one at the end of March, and the amount that they pay each and every time is 16,615, which includes capital and interest. The payment on 30 September was done correctly, but Pat was unsure how to record the payment for March. He credited the bank and debited the interest expense account with the full amount that they have paid. Great. Now what we have to determine, they said up to the end of September, everything was hunky-dory. Then he didn't fiddle around with the loan account. So when he made the last payment, he credited bank, which is 100% correct. But instead of splitting the 16,615 in March, also between interest and capital, he took the full amount in this question to the interest expense account. What should he have done? He should only have taken the interest portion to the interest expense account, and he should have taken the capital portion to the capital outstanding loan account. Now that mortgage loan account of 231,437, that would have been the correct balance as at the end of September. So we can start our calculations exactly there. So 231,437 was our mortgage loan at the end of September. Now we have to work out what was the actual interest for the next 6 months up to the end of March. So 231,437, they gave us the interest rate of 12%, multiplied by 12%, multiplied by 6 months, gives us then a total of 13,886. So that 13,886 still needs to be recorded in our books. Well, in actual fact, he has by implication recorded that amount because he took the full 16,615 at the end of March and he took it to our interest account. So basically what we still have to do is we will have to take out the capital included in the interest and then post it out of the interest account into the capital account. If the installment was 16,615 and 13,886 represented interest, it means that the difference between those two equals 2,729, and that was the capital repayment that took place. So what needs to happen is that I have to take that capital repayment out of my interest account and pass it over to my loan account. Did it increase my loan or did it decrease my loan? Guys, it decreased my loan, and if I decrease a liability, I have to debit the liability. So I'm going to debit the mortgage loan liability account with 2,729, and I'm going to credit my interest on my mortgage payments with 2,729. So if we go and have a look here at the mortgage bond, we said we're going to decrease this amount with 2,729, and then simultaneously we're going to credit this account, and we're going to credit an expense account. We're also going to reduce that account with 2,729. Once we've taken out the 2,729 out of that amount, our interest on the mortgage bond amount will be correct. If we're going to take out the 2,729, whatever's going to stay behind there, that will then represent our total outstanding loan at the end of the year. Now, 231,437, the balance at the end of September, less 2,729 gives us now a balance of 228,708. But now remember in this question, I have to do my statement of financial position, and therefore I need the short-term portion of the long-term loan. Although the total long-term loan at the end of March is 228,708, I need to carry on with my amortization table so that I can determine how much capital will be repaid in the next 12 months after year end. So now just continue 228,708 multiplied by 12%, and the next payment is going to be September, so it's only 6 months, so the interest there is going to be 13,722. Total payment is still going to be 16,615, interest portion 13,722, so capital repayment at the end of September 2,893. The outstanding capital balance then at the end of September of next financial year is going to be the 228,708 less the 2,893, which gives us the 225,815. For the next 6 months, the last 6 months of the next financial year, we're going to pay interest at 12% on 225,815 multiplied by 6 months. 225,815 times 12% for 6 months, and that gives us 13,549. Now we're going to pay 16,615. 13,549 included in that amount represents interest, so the difference must be my capital repayment. And that gives us a total of 3,066. So at the end of the next financial year, our outstanding loan balance is going to be 225,815 less 3,066, which gives us 222,749. Now the 222,749 is going to be the long-term portion of the loan. So under non-current liabilities, we will show mortgage bond with our outstanding balance 222,749. 222,749. Our capital repayments that we're going to make next year is going to be the 2,893 plus the 3,066. So in total, it's going to be 5,959. So under current liabilities on our statement of financial position, as a line item on the face of the statement of financial position, short-term portion of the mortgage loan, 5,959. And guys, if you're going to add the 222,749 with a 5,959, you are going to come back to the total outstanding loan at the end of the year, which is 228,708. So 5,959 plus 222,749 will bring you back to the total outstanding loan of 222,708 at the end of the year. Right. Do you see that we do not pass any accounting entries for the short-term, long-term portion? This is purely for disclosure purposes. So it's only on the statement of the financial position that we're just going to do that split. Good, here, oh, I've missed this completely. Since 1 November 2011, a portion of the office building has been rented to Daniel's cousin, who runs an internet cafe. The contract includes a rental increase of 5% on each and every anniversary date. Now, anniversary date is then every year on 1 November, so 12 months after they've concluded the contract initially. In March 2015, the internet cafe paid the rental for April 2015, so for next month, but debited the bank. He received the money, which is right, and he credited the rental income with the full amount received. So the full amount received will include VAT. This is the only rental that Daniel Jack receives. So if we go to our rental income account here, rent income 26,894. So that means that 26,894 equals an amount of normal rent received of 7 months. So our financial year end is 31 March. So from 1 April last year up to 1 November last year, that is 7 months, which he has received a normal rate. Then the next 12 months we have also received 1 month in advance. So that means we received in total 13 months rent. But the next 5 months rent was at the escalated price, 105x for 5 months. And then for the last month, old Bud has missed the plot. And for that 1 month of which he paid the escalated rent, He also posted the VAT to the rent received account. So therefore, it's not only the amount net of VAT, but also the amount inclusive of VAT. Now, if you work that all out, X is then equal to 2,000 Rand. Now, what did we receive in advance? Not the 2,000 Rand. We received the 2,000 Rand multiplied by 1.15, i.e. the escalated amount, 2,100 Rand. We also, what did he do? He also took the VAT, 2,100 times 14%. And that equals an amount of 294 Rand. Not mistaken, 294 to that rent income account. So how are we going to rectify that? We are going to debit rent income. With what? With the full amount that he has posted to that account that belongs to April 2015. And what was that full amount? 2,100 plus the VAT of 294, so 2,394. He's going to credit income received in advance. With what? The VAT exclusive amount of 2,100, and he's going to credit the VAT account with a VAT portion of 294 Rand. So if we're going to do that here, our rent income is going to reduce with the full amount that he has posted, which belongs to next year, 2,394. He is going to increase his VAT output account because he receives the VAT, so that's a credit balance. It will increase that balance with 294 Rand. And we are going to create here another creditor, which I want to insert here, income received in advance. And that income received in advance is the VAT exclusive amount of 2,100. And now the whole thing is in balance. Number 6 here, which I also just jumped, an age analysis of the debtors ledger was done, and it was discovered that Mr. Castle had a balance of 5130, which was over 120 days old. It was discovered that he had fled the country, there was no chance of recovering the monies, and we should write off the debt. So that one is the easy one. We're going to have credit losses. Yeah, let's put it there. Which is going to be what? The VAT exclusive amount. So the VAT exclusive amount is 4,500. We're going to write off the full amount against debtors. So the full amount of this credit loss was 5,130. 4,500 was the VAT exclusive amount, and now we're going to claim the VAT, which is going to reduce our credit balance with an amount of 630 Rand. So we're going to debit credit losses, 4,500. We're going to debit VAT output with 630, and we're going to credit debtors with a full amount of 5,130. And then they tell us that we have to adjust our allowance for credit losses to be equal to 5% of our outstanding trade debtors. Now, if we go to our trade debtors account, we will see now that our outstanding debtors is equal to an amount of, where do we see that? 79,230 less 5,130. 79,230 less 5,130, that gives us a total of 74,100 Rand. So what do? We take the 74,100, we take out the VAT, and we will multiply that by 5% to give us our closing balance. Divided by 1.14 times 5%, so the closing balance that we want is 3,250. Do we have an existing balance in our books? Yes, there somewhere. Allowance for credit losses 4320. We do not want that balance anymore. The new balance that we want in that account is the balance of 3250. Now, if we had a credit balance of 4320 and we want the credit balance now of 3240, it means that we're going to debit the allowance account with 1070. Going to debit that account with 1070, and we're going to credit a credit losses allowance account adjustment account, or we can credit it directly against our credit losses account. So that means if we're going to do that, our credit losses would then be 3430. Great. Number 7 we've done. Number 8 we've done. Cash and cash equivalents comprise the following: petty cash, 30-day school deposit, bank overdraft, and 12% investment at Salmon matures in March 2017. Now, March 2017 is not in the next 12 months after year end. So therefore, because it's in a term longer than 12 months after year end, that 40,000 is going to be shown as a financial asset. So in your statement of financial position, if you go there on the asset side, I'm going to have non-current assets, property, plant and equipment, and then underneath that financial assets, 40,000 Rand. Furthermore, we also have to calculate what was the interest that we should have received on that investment. So that's the 40,000 multiplied by 12%, multiplied by the number of months, which is 8 months that we've had that investments already as at the end of March, and that gives us then total interest of 3,200 Rand. Now, if you go back to your trial balance, you will see that we do not show any investment interest. We only show the interest on the 30-day deposit. So obviously here, we will have to add that amount of 3430, and then interest receivable is going to be shown here as part of trade and other debtors. So I'm going to insert it there under other interest receivable, and that is going to be a total of 3430. Let's also adjust that figure. That is not the figure anymore. The correct figure that I think that we've said there was 74,079,230. Let's 513 word. 74,100, yes. Right. Then we're done with that one as well. We've dealt with that one. Bank overdraft. We know that the bank overdraft is shown as a separate line item in the statement of financial position under current liabilities. So there's a line item, bank overdraft, 9,400. So you can insert it in your template. Good. And then the 1,500 and the 20,000 petty cash in the 30-day school deposit, that is cash and cash equivalents. So on the asset side of your statement of financial position under current assets, cash and cash equivalents, 21,500. Let's quickly run through the question now and see what did we miss. That cash and cash equivalents is not the final balance because they gave us the final balance. Well, that is when I add all those together. So I've split it up and I've shown it all over the show in all the different spots where it should have been shown. Property, plant and equipment, carrying value. They said that that is correct. We don't have to worry about that. We do not have any further information than that. So therefore you can assume it's correct. So 1450 under assets, property, plant and equipment, 1450. With our financial assets, our investment of 40,000, that will give us total non-current assets of 1490. Under current assets, we've already spoken about inventory, which is at 24,000. Let's do trade and other debtors. Trade and other debtors. It's our debtors of 74,100, the amount that we've just adjusted on the trial balance. Our allowance for credit losses we've worked out as 3250. There it is, 3250. So our net trade debtors is 70,850. And then our interest that's receivable is 3,200. If you remember correctly, I've added it there. Ooh, where did I get 3430? I would like to answer. 3,200, guys. 3,200. That is the correct answer there. Interest receivable, 3,200. And let me just check here. Interest here is 3,200. So that amount should have been 3,200. Great. Then, where's our question? We've dealt with raw materials, work in process, finished goods, and allowance for unrealized profit. The VAT control, we can take now the 16,900. We can pass all the adjustment entries, and we'll see that we're still going to end up with a net credit balance. So it's the 16,900. There's all three our adjustment entries. So we will still end up with a credit balance of 13,414. So trade and other payables, we will have VAT control, 13,414. Then equity. Under equity, we will have our capital of 746,500. 746,500. We will have our drawings of 59,020. 59,020. Wait a bit with you have to complete your income statement first before you can transfer your profit. So that one is a blank for this at this point of time. Mortgage bond. Well, we've already done the mortgage bond, the short-term and the long-term portion. Debtors, we've done debtors and interest receivable. We've done allowance for credit losses. Creditors, 77,500 plus 25,650. So trade and other creditors, 77,500 plus 25,650 gives us 103,150. Our allowance for settlement discount under creditors would have been the 950 plus the 450. So here allowance for settlement discount in total 1,400. So our net trade creditors is 101,750. We've already spoken about the VAT control account, and we have inserted here on income received in advance of 2,100. So we can add that now in our note, 2,100. And guys, although we didn't have to do the note, you will actually still have to do the note to get to the correct figure to put on the face of your statement of financial position. So total trade and other creditors 117,264. Trade and other creditors 117,264. Great stuff. Sales, that will go to our income statement, and that is going to be the 3,890,000. The statement of profit and loss. Sales 3,894. Now we're going to come to let's do the rent income quickly, and that would be under the gross profit line. We've already done that rent income. And that would have been the 26,894. Let's just park the cost of sales a little bit. Rent income is going to be the 26,894 less the 2,394, which gives us 24,500. Right, let's continue with this. We will do we'll handle that. Interest on the mortgage fund, 3656 less 2729. So interest expense here is 3656 less 2729. That is the 27,927. Interest on the 30 days deposits is the 1,405 plus the 3,200, and that's interest received. So interest income is going to be in total 4,605. Selling expenses is a normal operating cost, 212,000. So here's selling expenses, 212,000. We will have admin expenses of 326,000, admin expenses of 326,000, and then here at the bottom we have inserted the unrealized P&L's got to do with cost of sales, so credit losses 3430, that is after I've deducted the adjustment for the allowance account, so there we would have shown credit losses 3430. Great stuff. So let's go to cost of sales. What is cost of sales now all about? Opening inventory, remember it's a periodic system, so cost of sales is really a calculation. They gave us the opening inventory, and that was 101,200, but remember that includes the unrealized profit. So somewhere along the line we will have to update our unrealized profit P&L account if we want to calculate the correct cost of sales. So let's start with all the blown up figures. 101,200, which is my opening inventory. Then it's not purchases or something ridiculous like that. It is now the cost of goods manufactured that we're going to include here. Now the cost of goods manufactured is going to be the 25,500,000 plus that adjustment entry of 22,050. That was this one here. This 25,650, if we take out the VAT, it's that 22,050, the 98%. So we're going to add that to the cost of manufacturing. Our total cost of manufacturing is now that one plus that one, but that is actual cost. Now remember that we have to inflate that with a 10%. So 2550 plus 22,050 times 10% give us a total of 257,205. So our inflated cost of goods manufactured would be the 2550 plus the adjustment entry plus the 10% on those two entries, which is 257,205, which will then give us a total of 282,9,255. Our closing inventory they gave us, and they said to us, our closing inventory, which will include, this includes the manufacturing profit, is 107,800. Remember, if you start working with inflated figures, you have to continue with that. You cannot work the one moment with an inflated figure and the next moment with a figure that does not include any unrealized profit. So therefore, that's also the inflated figure. Now, that gives us an inflated cost of sales of 282,655. Now, what do we offset against the inflated cost of sales to get to the actual cost of sales? The balance on the unrealized profit P&L account. What did we pass to this account? Now, the unrealized P&L account will have the allowance for unrealized profit opening balance, 9,200. Remember, it was a credit balance, so we would have debited the allowance account and we would have credited the unrealized P&L account, 9,200. Then we would need it at year end, remember, here we are now. That was the 9,200 opening balance. So if I draw a T account, it would have been a credit balance. We said we've realized that opening balance. So we debited the allowance account and we credited the unrealized P&L account. That's that entry. At year end, we have 9,800 Rand in our allowance for unrealized profit account. So therefore, if we've taken out the opening balance, we have to put back the full 9,800 Rand because that is the closing balance that we want on the unrealized P&L account. So that's the 9,800. We will create the allowance account and we will debit this account. We could have done it either that way. What is the net of this? A debit of 600 Rand. Now, if you can remember correctly here, we've actually said we're going to debit our unrealized P&L account with 600 Rand. It is that 600 Rand. So you can either take the shortcut and do the 600 Rand, all what you can do is you can take the long road and put the 9,200 in and then create a new allowance account as at year end again. But you can see clearly there, the net impact is a 600 debit. Now, what was the amount that we've added to our cost of goods manufactured, which is in other words the 10% of our unrealized P&L, which we took the unrealized P&L, the 10% unrealized profit that we added to the actual cost of manufacturing, and that was the 257,205. So we debited cost of goods manufactured and we credited our unrealized profit P&L account with 257,205. And now the only thing that we have to do is to balance off this account, because the balancing figure that we're going to get here on the debit side is the manufacturing profit, which is going to reduce our cost of sales and eventually going to increase our gross profit. So that 256,605, I've put it down here as a separate line item, 256,605. So we're going to have a gross profit of 3,890,000 less 282,2655, but remember that figure is inflated. So we're going to reduce the inflated figure with 256,605, that figure there, in order to get to our actual gross profit of 1,323,950. And then we're going to add our other operating income, which is the 24,500. We're going to deduct our total operating expenses. So if we add that all up, it gives us 541,430. And then we're going to get our profit before financing activities of 807,020. We have received income 4605. We've paid interest of 27927. So our profit for the year is 783,698. And in our statement of financial position, profit for the year 783,698. If we now take our equity, our non-current liabilities and our current liabilities, it will give us a total of 182,6550, which will balance then back to our total assets of 182,6550. A very good question. It tests all the stuff that we've done this semester, so it's very good revision, and it has that little bit of flavor of the inventory and the disclosure. Disclosure, very, very important.